Come to question number 10. On 1st October 2015, underline 1st October 15, Pumice acquired the following non-current investment. 80% of the equity share capital of Silverton at a cost of $13.6 million. So they have made following investment. One investment is in equity share, 13.6 million. 50% of Silverton's 10% loan notes at par. Somewhere below in the balance sheet, 10% loan note is 2,000, but that figure is in 1,000. So you write here, can I say 1 million, 2,000 into 50%, and 1.6 million equity share in Amok at a cost of 6.25. So how much is this 1.6 into 6.25? 1.6 into 6.25. 10. So total investment made is how much? 13.6 plus 1 plus 10. 24.6. And how much is the investment appearing in the books of this company? 26. But this is only coming up to 24.6. So 26 is total investment, 24.6 is group investment, which means there are some others also, which is equal to 1.4. So there is a hidden adjustment here. The investment of Pumice includes 1.4 other investment. Okay, this is the cost of investment in subsidiary, 80% share. 1.6 million share in Amog out of 4 million share. Is it 40%? Say yes. In case of Amok, you are holding 40% share. Next line, the summarized draft before that. The fair value of 20% non-controlling interest is 2,500. This is NCI. We will require it for goodwill calculation also. The draft SOFP of 3 companies on 31st March. Now you understand the problem. All acquisitions were made on 1st October 15. Okay. And the year ending date is 31st March. So it must be 16. So number of months, 6 months. So 6 months of the current year is post, and remaining 6 months will be treated as pre. Non-current asset, property, plant and equipment, investment, current asset, total asset, equity and liabilities, equity share of $1 each, retained earning, non-current liabilities, 8% loan note, 4,000 nil, 10% loan note nil, 2,000 nil, current liabilities 10,000, 3,500 and 5,000. Total equity and liabilities. The following information is relevant. The fair value of Silverton's asset was equal to their carrying amount with the exception of land and plant. The land had a fair value of $4 lakh in excess of its carrying amount, and the plant had a fair value of $1.6 million in excess of its carrying amount. The plant had a remaining life of 4 years, straight line method of depreciation on the date of acquisition. So you tick mark property, plant and equipment. Okay. And there will be two adjustments in that. One for increase in the value of land, that is 4 lakh, and increase in value of plant 1.6 million, and you have to also provide depreciation for 6 months. 1.6 divided by 4 into 6 by 12. Additional depreciation you will charge in post acquisition period. Then the problem says in the post acquisition period, Pumais sold goods to Silverton at a price of $6 million. Who sold to whom? Parent to subsidiary, downstream. This is called downstream. These goods had cost Pumais $4 million. Half of them were sold for 6 million. Half of them were still in Silverton's inventory on 31st March. So half of this means how much profit was made? 2 million divided by 2. Unrealized profit is 1 million. How will you adjust this? This is a transaction with subsidiary. In the balance sheet, reduce from inventory and reduce from retained earning of the parent. Is it right? One you will reduce from inventory, contra effect, retained earning. Because this is downstream transaction to a subsidiary. Next line. Silverton had a balance of $1.5 million owing to Pumais on 31st March 2016, which agreed with Pumais record. So tick mark current asset 2 times. Current asset tick 2 times. One for inventory 1 million and one for intercompany transaction 1.5 million, and tick mark current liability 1 time for intercompany dues. The net profit after tax for the year ended 31st March 2016 was 2 million for Silverton and 8 million for Amok. So this is the profit of which year? Current year. So can I find out the profit of the previous year brought forward? How much is profit of previous year brought forward for Silverton? 6 million, 8 minus 2. And for Amok? Amok, 20 minus 8, 12 million. 20 minus 8, 12 million. And current year also will divide in the ratio of 1:1. So we will require one pre and post acquisition working. Okay. Then next line, profit was assumed to be earned evenly throughout the year, 6:6. An impairment test on 31st March 16 concluded that goodwill was impaired by $4 lakh. An investment in Amok was impaired by $2 lakh. So you have to provide 2 impairment losses here. One for goodwill, one for investment. What is the status of Silverton? Is it a subsidiary or an associate? Subsidiary 80% share. And what about Amok? We are holding 40% share. So assume associate. No dividend was paid during the year by any of these companies. Very good. So then why this adjustment is given? Unnecessary, waste of time. Prepare the consolidated SOFP for PUMIS as at 31st March 2016. Okay. So first we will understand the formats that I am going to use. This is your consolidated financial statement of PUMIS. Write down the date as at 31st March 2016. Okay. Next we will use consolidated statement of changes in equity. We have share capital, retained earning, NCI total, opening balance, share in post acquisition profit of subsidiary, associate, less impairment of investment in associate, less goodwill impairment, and less unrealized profit on stock also, because there is a downstream transaction. And in this question we will prepare one analysis of profit statement for the two companies, Silverton and Amok. In Silverton column write in bracket subsidiary, in Amok column write associate. And then calculation of goodwill for Silverton, Amok. In case of Amok, if it is goodwill, no further action is required. And then carrying amount of investment in associate. Okay. So should we start now? So start from cost of acquisition. 80% of equity share capital of Silverton was acquired at a cost of 13.6. We will write in 1000. Okay. So how you will present it if you have to write in 1000? 13,600 right here. And what is the cost of acquisition of Amok? 1.6 into 6.25. 10,000. And then we'll come to our main page. Here, financial asset, investment, other investment. So other investment total is 26,000 minus 13,600 plus 1,000 in loan asset and plus 10,000 in Amok. So the remaining other investment is outside investment. It comes to 1,400. And you have to cancel 1,000 loan when you will come to liability side. Okay. This 10,000 cost of investment in Amok, you also write in working note number last. Cost 10,000. Now we will go by balance sheet line by line item. Property, plant and equipment. First you just write down these two numbers. 20,000 plus 8500. Do not add Amok, associate. What about adjustment? Come to adjustment number 1 below, we'll do it immediately. The fair value of Silverton's asset was equal to carrying amount with the exception of land and plant. The land had a fair value of 4 lakh in excess of carrying amount plus 4 lakh. And the plant had a fair value of 1.6 million in excess of carrying amount plus 1,600. But plant will be depreciated over 4 years. So 1600 divided by 4 into 6 by 12. So what is the final answer in the outer column for this property, plant and equipment? Final answer 20,000 plus 8,500 plus 400 plus 1,600 minus depreciation 30,300. Okay, now understand, I have to give the effect of these three extra adjustment I have made. 400 plus 1,600 will be written in pre-acquisition column. So you write down in pre-acquisition column, keep first 4 or 5 lines blank. Fair value adjustment. Under that first write down land 400, plant 1,600, then write extra depreciation on plant. How much was that extra depreciation? 200? 200. So this completes my adjustment relating to PPE. Investment. Investment we have done. Amongst investment we will not add. That is given to confuse you. Current asset, asset side, current asset. You will first write 15,000 plus 8,000. And what about the unrealized profit on inventory? Point number 2, in the post-acquisition period, adjustment number 2 in your notes, Pumice sold goods to Silverton at a price of $6 million. These goods had cost Pumice $4 million. Half of them were still in the inventory, means 1,000. And one more adjustment. Silverton had a balance of 1.5 million owing to Pumice at 31st March 2016, which agreed with Pumice record. Minus 1,500 intercompany dues, intercompany receivables and payable. So what is current asset finally in the outer column? 20,500. Okay. So this 1,500 adjustment I have to do on the liability side. Two items we have to adjust in liability side, loan and current liability. Any query on the asset side? Liability side. Share capital, equity share 10,000 right here. Share capital 10,000. And you also write in consolidated statement of changes in equity 10,000. And how much is the retained earning of the parent? Right here, 37,000. And how much was NCI on the date of acquisition? 2,500. At the top, write that also, so that this line is complete. Tell me the total of this. 10,000 plus 37,000 plus 2,500. So that is 1,000 only. This NCI, na? You write down in 2,500 in bracket, in 1,000. In 1,000. You can make it 2.5 million. Now tell me this total. How much is this? Total 10,000, 37,000, 2,500. 49,500. Next is, we'll go to NCI, second effect. Where is NCI? In that goodwill calculation. Right here 2,500. Total A. Is it 16,100 and 10,000? Now what you do, come to subsidiaries share capital. Subsidiary share capital is how much? 3,000. Write 3,000 here. And subsidiaries pre-acquisition profit we have to work out. So go to working note number 1. So you write down like this: retained earning dash opening balance. Opening balance of retained earning will be, current year profit is 2 million, which means opening balance must be how much? 6 million, 8 minus 2, and then write down retained earning current year. Current year in bracket ratio 6:6. So current year is 2,000. In the ratio 6 months, 1,000, 1,000. Is it right? Wait. Amok, you take 20,000 is the total and current year is 8. How much is that? 12,000. And current year, you apportion in the ratio of 6:6. 4,000, 4,000. The unrealized profit on stock contra effect you have not given. So you can give now if you have not given. Unrealized profit on stock. How much was that? Right here. If you have not yet given, 1,000. 1,000. Looks like 1,000. Now, come to Amok's share capital and Amok's retained earning. Amok's share capital we have not given the effect. So you come to this goodwill working. How much will you write? Do not write 4,000. You will only write 40% of 4,000. 1,600. 40% of 4,000. Only your share. Whereas in subsidiary, you will write 100%. Retained earning is over. 8% loan note, 10% loan note, current liabilities. 3 items are pending in balance sheet. 8% loan note. 4,000 plus 0. 4,000. 8% loan note, write down 4,000. 10% loan note, 0 plus 2,000. But out of 2,000, 1,000 is held by parent company. So you will write in the outer column 1,000. Current liabilities 10,000 plus 3,500. And how much is due to other company? minus 1,500. So what is the answer? 12,000. Done. So see, second effect of all three adjustment I have given. This was unrealized profit on stock, I have done. This is intercompany receivable, done. Intercompany payable, done. And this loan note 1,000 also we have adjusted. So second effect is over for all adjustment. Now you come to adjustments in your question. Point 1 we have done fully. Point 2 we have done fully. Point 3 also we have done fully. Now they are talking about two impairments. On the screen, SOCIE. Impairment of goodwill was $4 lakh. So impairment of goodwill right here, 400 in 1,000. And investment was impaired by 200,000. Investment impairment 2,000. 200,000. Uh-huh, 400 goodwill, because we are using fair value method. So goodwill will be a portion between parent and NCI. How much? 80% of 400? 320 and 80. Now give the second effect. This goodwill working note less impairment, right? 400. And last working note, carrying amount of investment, keep one line blank and then write less impairment. How much was that? 200. 200. Now what you will do, close the working note on pre and post acquisition profit. Is it right? So come to working note on pre and post acquisition profit. Take total of all the columns. First column total is how much? Very good, 9,000. Then 800. 16,000. 4,000. Parent company P has a stake of 80% oblique 40%. 80% in Silverton. NCI, one line blank, NCI 20% in one company, Silverton. This 9,000 do not divide. This 9,000 I will fully transfer to this S Limited pre-acquisition over here. I'll come back to this working note. First you transfer 9,000. You can write in bracket working note 1. Okay. This 800 you divide in the ratio of 80-20. 80-20. 800 divide in the ratio of 80-20. 640 and 160. Now these two numbers 16,000 and 4,000, no NCI there, only parent company 40%, 6400 1600. Okay, this 6400 you write in amongst pre-acquisition here 6400 to check whether it is goodwill or gain on bargain purchase. Then what about this post acquisition? 640 1600 and NCI 160. So I will go to statement of changes in equity and I will write add share in post acquisition profit of subsidiary. Parent share is how much? NCI share is how much? Total is how much? And share in post acquisition profit of subsidiary, is it 1600? 1600. Wait a minute. You have to also go to that last working note. In that last working note, you have to write add, second effect, add share in post acquisition profit 1600. Now start the closing ceremony of this problem. Take the total of 10,000 plus 1600 minus 200, 11,400. Then calculate goodwill in the first column before impairment. What was goodwill before impairment? Goodwill 4100. And in second column 2000. So since it is goodwill, no further treatment. Goodwill after impairment on the date of consolidation. 4100 minus 400, 3700. Here you write down no further adjustment. And this 3700 you transfer to SOFP. Right. Then you come to this consolidated statement of changes in equity. Tell me the total first of each column. 10,000, 37, then 25, and last column 50,300. Now we'll complete the balance sheet. How much was goodwill once again? What is the total of asset side? 67? Oh, very good. Investment in associate 11,000? Right here. And then other equity 37? And what about this NCI? 2580. This answer is over. What is the total? 67,300. Okay. Now one more simple question is pending. Question number 13. Come to question number 13. Alpha holds investment in two other entities, beta and gamma. The statement of financial position of the three entities on 31st March 2013 are as follows. Assets, non-current asset, property, plant and equipment, investment, current asset, inventories, trade receivable, cash and cash equivalent, total asset, equity and liabilities, equity, share capital of $1 each. Retained earning, other component of equity, note 236. Total equity, non-current liabilities, provisions, note number 7. Long-term borrowing, note number 8. Deferred tax, total non-current liabilities. Current liabilities, trade and other payable. Short-term borrowing, total current liabilities, total equity and liabilities. Note number 1. Alpha's investment in beta. On 1st April, Alpha acquired 90 million share in beta. So 90 by 120. What is the percentage in beta? 90 by 120? 90 million share by 120. So can I say this company Alpha is holding 75% share in beta? So what is NCI stake in beta? 25. So this is a subsidiary, we will assume. The terms of the business combination were as follows. Alpha issued 8 share for every 9 share in beta. On 1st April 2012, market value of an Alpha share was 2.80. So this will help you to calculate the consideration. 8 by 9 into 90 into 2.80. This is the consideration in the form of equity share. How much it comes to? 224. Sure. Is it 224? Seems to be right. Alpha will make a further cash payment to former shareholders of beta on 30th June 15. This payment will be based on the adjusted profit of beta for the 3-year period to 31st March 2015. On 1st April 12, the fair value of this additional payment was estimated at $25 million. This estimate had increased to $28 million by 31st March 2013 due to change in circumstances since the date of acquisition. This is called contingent consideration. Contingent consideration as per IFRS 3 will be valued at fair value 25, and then there is a change in fair value which we are going to adjust in retained earning 3 million later. Neither component of the investment in beta has been recorded in the draft financial statement of Alpha presented above. So that investment which is appearing in Alpha's book does not include these 2 adjustments. So there is a serious mistake they have made. They have not recorded this investment only. So you tick mark equity share also. This equity share will also increase by 80 million shares into 1. And your liability side will have one more item. This contingent consideration payable. It is the group policy to value the NCI in subsidiary at the date of acquisition at fair value. The market value of equity share in beta on 1st April 12 can be used for this purpose. On 1st April, the market value was 2.60. And how many shares are held by NCI? 30 million. 120 minus 90, and the value is 2.60. So fair value of NCI on the date of acquisition, 78 million. Next line. On 1/4/2012, the individual financial statement of Beta showed the following reserve balances. Retained earning $86 million, other component of equity $2.4 million. So these are pre-acquisition figures. The directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of Beta on 1st April 12. The following matters emerged. Property having a carrying value of $140 million, depreciable component $80 million, had an estimated market value of $160 million. So increase in value is 160 minus 140, 20 million. An increase in depreciable component is 92 minus 80, $12 million, divided by the total economic life is 16 years, divided by 16. And how many years are over? Only one, into 1. 0.75 you will write in post column extra depreciation. Haji? Yes or no? Next line, plant and equipment having a carrying value of 111 million, had an estimated market value of 120 million. So how much is the increase? 9 million. The estimated future economic life of plant was 3 years, divided by 3. So in the post-acquisition period, you will charge 3 million. Beta has not disposed any of this plant and equipment since 1st April 12. Very good. Intangible asset with an estimated market value of 8 million. Again write 8 million in the pre-column. Had not been recognized in the individual statement of Beta. The estimated future economic life of intangible asset was 4 years, divided by 4. So 2 million you will charge in the post period. Then the fair value adjustment have not been reflected in the individual financial statement of Beta. So sad. So you have to record. In the consolidated financial statement, the fair value adjustment will be regarded as temporary difference for the purpose of computing deferred tax. The rate of deferred tax is 20%. No impairment of goodwill on acquisition of Beta has occurred since 1st April 2012. Note number 2. Alpha's investment in Gamma. On 1st April, Alpha acquired 40 million share. Now 40 divided by 100. Again 40% write down. If nothing is given, you assume associate. Okay. Between 20 to 50%, if there is a stakeholding, presumption is associate unless otherwise given in the problem. 40 million share for a cash payment of 1.85. Multiply 40 into 1.85. Is it 74 million? Is written there, and debited 74 million to investment in its own statement of financial position. But if you look at the statement of financial position now, it is appearing 78.5 million. Why there is a difference? They have explained below. Don't assume other investment. Read the full question. This enabled Alpha to exercise significant influence over Gamma. So Gamma is associate, but not control Gamma. In its own financial statement, Alpha treated the investment in Gamma as a financial asset and made an election to measure it at FVT OCI. So that is treated as FVT OCI, and probably that is the reason there is a fair value difference here. Okay. Next line. The story is not over. On 1st April 2012, the individual financial statement of Gamma showed the following reserve. So these are pre-acquisition reserves, 66 million, 1.2 million. If you look at the SOFP given to you, now the retained earning is 76 million. Is it 76? And this other component of equity of associate is how much? 2. So this change has taken place. You will calculate 40% of this change and add in retained earning plus investment in associate, add in OCI plus investment in associate. That's it. That is the only treatment we are going to give for this. Right. Next line. On 1/4/2012, there was no material difference between the carrying value of the net asset of Gamma in the individual financial statement and the fair value of those net assets. On 31st March 13, fair value of Alpha's investment was estimated at 78.5 million. Now this is what they have done. They have measured the investment in individual statement at FVT OCI. And this is the balance recorded in Alpha's individual statement. On 31st March, Alpha credited this 4.5 million to the other component of equity. So when we are doing consolidation under IAS 28, you reverse this effect and you apply this standard. So 4.5 I will remove from investment and OCI. Very good. Next line. No deferred tax was recognized when making this entry. Very good. So no deferred tax adjustment for this item. In the consolidated financial statement, you can ignore deferred tax when measuring investment in Gamma. Investment by Beta and Gamma. You will find some investment is made by Beta and Gamma. These investments are financial asset measured at FVT OCI and have been correctly treated by Beta and Gamma. The other component of equity of Beta and Gamma relate entirely to those investments. So the change in that OCI in Beta and Gamma is due to change in fair value of other investment. Beta's investment will come in our balance sheet. Gamma's investment will not come in our balance sheet. And the change in OCI will be added to our OCI, parent's OCI. Okay, that's it. Very simple. Intercompany sale of inventory, the easiest thing. Inventory of Beta and Gamma on 31st March 2013 included component produced by Alpha. The selling price of this component included in inventory of Beta is 14 million. Selling price of component included in inventory of Gamma is 12. 14 plus 12. 26 million. Alpha applied, but will give different treatment. 14 different because it is subsidiary and this is associate. So for subsidiary, 14 into Alpha applied a markup of 1/3 of the cost, means 1/4 of the selling price. To arrive at the selling price, ignore deferred tax. Very good. But in case of the associate, to eliminate the unrealized profit, I will also multiply by 40%. So how much will you eliminate here? How much will you eliminate here? This will be adjusted in retained earning and inventory. This will be adjusted in retained earning and investment or inventory. Where is the inventory? With Gamma. Are we consolidating gamma's inventory with us? No. Investment. Next line. Point number 5. This is again very easy. The trade receivable of Alpha included $9 million receivable from Beta and $7.5 million receivable from Gamma. In respect of purchase of component, the trade payable of Beta and Gamma included equivalent amount payable to Alpha. So you will go to asset side when you prepare the answer. Remove 9 and 7.5 from trade receivable and remove 9 and 7.5 from trade payable. Point number 6. This is something important. This will test your knowledge of now IFRS 2. Let me see who will give the correct answer. But this is very easy. On 1st April 2011, 1st April 11, and what is our year ending date? 31st March 13. This is our current year ending date. This is grant date. On 1st April 11, Alpha granted share options to senior executives that are due to vest on 31st March 14. So vesting date is 31st March 14. So total vesting period 3 years. Number of years complete 2. 2 years are complete. So I need to recognize 2/3 of the total estimated expense. Until last year, that is 31st March 12, 1 year, they must have already recognized 1/3 of the total estimated expense. So current year estimated expense will be, current year expense to be charged to P&L account will be 2/3 of the total estimated expense minus amount already recognized in the previous year. Correct? This is what you have learned. Current year expense equal to 2/3 of revised estimate minus expenditure already recognized in the previous period. If you can remember that adjustment, you will be able to solve. The maximum number of options that can vest is 10 million. However, there are vesting conditions that are service condition. Each option allows the holder to purchase a share in Alpha for $2.50. Now that is called exercise price. Exercise price does not affect right now my expense calculation. Exercise price is used in calculation of option value, which they must have already included in option value. Now there are different numbers given to you, but most of these are irrelevant. 1st April share price is given, fair value of the option is given, and number of option expected to vest on 31st March 14 is given. So do we take share price in the calculation of option? No. In the calculation of employee benefit expense? No. So 36 cents we will take. 36 cents means $0.36. And the fair value of the option decided on grant date is not changed unless there is a modification in the scheme. So that 0.36 will remain in calculation for all the 3 years. Is it right? Which means other option values given to you are not important. Share price given to you is not important. Number of option expected to vest is important. That will keep changing every year. So that will be considered. So last year they must have taken 1/3 into 9.2 million into 0.36 in their calculation, something like this. Okay. And this year they will take 2/3 into 9.3. 9.3 is right, because at the end of this year 9.3 million are expected to waste, and into that 0.36. Let us read further. I will explain again. On 31st March 12, directors of Alpha correctly credited, means they are talking about last year, correctly credited other component of equity and debited profit or loss with 1,104,000. So this calculation they are explaining it to you. Last year how they must have calculated, understand, they must have taken 9.2 million expected number of option to waste, multiplied by 0.36 and divide by 3. Just check. Are you getting 11.04? Okay. And this year what you will do the same calculation, 2 by 3. Now the revised estimate is 9.30 into 9.30 into fair value of the option 0.36. So how much this comes to? 2 by 3 into 9.30 into 0.36. 2.232. You have learnt in this chapter IFRS 2, cumulative expense minus previous year expense is current year expense. 1128. This we will recognize in current year. Okay. Huh? What happened? My handwriting is not that bad, computer is bad. Employee benefit expense account debit to employee benefit share based payment reserve account. To share based payment reserve account we will show in OCI, other component of equity. While preparing other component of equity working note, you add this number 11,28,000 there and reduce it from the profit, that is retained earning. Is it right? Is this adjustment number 6 clear? Do not change the fair value of an option which you have decided on the grant date. So only 36 cents will be relevant in calculation of all the answers. And then you have to estimate total expense, compute cumulative expense, deduct expense already recognized up to previous year, and then you get the difference, which is current year expense. Entry for current year expense account debit to share based payment reserve account. Point number 7, provision. One more new adjustment you will learn today. On 1st October 2011, 1st October 11, Alpha entered into a 10-year lease of office premises at an annual rental of 20 million. This lease was correctly classified as operating lease and the rentals appropriately charged to profit or loss. On 1st October 11, Alpha began carrying out alteration to the premises. This alteration was completed on 31st March 12 at a total cost of $18 million. Alpha included $18 million in its property, plant, equipment on 31st March 12 and charged depreciation in the current year based on 9.5 year useful life. So what is the cost of this alteration? In thousand, if I have to write, 18,000. And how much depreciation they have started charging? It based on 9.5 year of useful life. So how much is your depreciation they have charged? 18,000 divided by 9.5 year. How much is that? 1895 they have charged. Now let me check what is the year ending date. Year ending date. Okay, we'll see, just a minute. And charge depreciation in the current year based on 9.5 year useful life. Next line, the term of the lease require Alpha to vacate the premise on 30th September 2021 and leave them in the same condition as they were on 1st October 2011. The directors estimate that this will require restoration expenditure of, how much is that? $14.25 million. When will that be incurred? On 30th September 2021. Accordingly, the director recognized a provision of 1.5 million. Why 1.5 million? Divided by 9.5 at 31st March 2013. The directors debited 1.5 million to profit or loss when recognizing this provision. A relevant discount rate to use in any discounting calculation is 8%. The present value of $1 payable in 9.5 years at this discount rate is 48 cents. So many standards are coming into play. You have to make a provision for decommissioning liability. Okay. How much provision for decommissioning liability you should have made? Present value of this number 14250 into 0.48. How much is that? 6840 should be the provision they should have made. And on that they will calculate interest for 1 year also. So how much interest at the rate of 8% they should have charged in this year? 547, which they have not done. What is the contra effect of this 6840? It will be added to asset also. It will be added to asset also. Since you have not added to asset, you have not provided depreciation also on this additional amount. So how much depreciation on 6840 you would have provided? Huh? 720. So what I have not done, this year I have to provide for interest 547. This year I have to provide for depreciation 720. So total I should have provided, which I have not provided, 12,667. And instead of that, what they have done, the directors have recognized a provision of 1500 in the profit and loss account. So actual amount they have provided is 1500. So they have actually charged more or less. This is the amount they have provided in P&L account. This is the amount that should have been provided. This is actual. No. This is actual, and this is what we should have provided. Should. And this is actual. So, difference between the two, we will reverse back. How much will reverse? 233. Is it right? So now you understand the whole story again. First we'll pass an entry for provision for decommissioning liability. Asset account debit, whatever is that asset, to provision for decommissioning liability 6840. Then we'll pass one entry, interest account debit 547, to provision for decommissioning liability 547. Then I will pass an entry depreciation account debit to asset account 720. Okay. And then these two account we will not transfer to P&L account. Instead of that, I have already transferred 1500 to P&L account. So I will pass an entry for reversal. This 233 that we have extra charge, we will reverse it. Okay. So now we'll come to next paragraph. Long-term borrowing. The long-term borrowing of Alpha include $20 million that was received from a consortium of bank on 1st April 2012. The loan does not carry any interest. How is it possible? Zero coupon loan. The loan does not carry any interest, but 30.6 million is repayable on 31st March 17. Alpha incurred incremental cost of $1 million in arranging the loan, which were charged to P&L account for the year ended 31st March 2013. Should it be charged to P&L account? No, it should be adjusted in the loan. So it should be 20 million minus 1 million. 19 million should be the opening balance, and the effective annual rate is 10%. So they should have charged 1.9. Okay. But how much they have actually charged? They have transferred that entire 1 million. They have transferred entire 1 million. Okay. The effective annual rate of interest was 10%. So we have to charge some extra expense here. Now next is prepare the consolidated statement of financial position. So this is a long problem. Start. $900 extra we will provide later. Keep this adjustment in mind. So this is a very good question which tests your knowledge of many other topics. IAS 32 is involved, or IFRS 9 is involved, IFRS 2 is involved, IFRS 3 is involved. Okay. IAS 28, IFRS 10. Deferred tax also, IAS 12. So can we start and finish today? Yes. Action. First you tick mark these two figures. Don't add gamma, that general instruction you follow. So tick mark alpha and beta. We'll come to this other adjustments later. Investment in gamma will come to working note 9. Investment in gamma, equity accounting. First write down the cost only. How much is the cost? $74,000. Then what about the investment of beta? Will it appear in the SOFP? So write down there. Other investment 40,000. Other investment 40,000 will appear. Next line, current asset inventories. For the time being, just tick mark 85,000, 56,000. Trade receivable tick mark 70,000, 42,000. Cash and cash equivalent 14,000 plus 11,000, total in the outer column 25,000. Total asset, equity. Now in equity, there is an adjustment. 1,60,000 plus 80,000 share issued to acquire beta. So that will become 2,40,000. Now we have to give second effect also of this 80,000. So this will come in this goodwill calculation. In this goodwill calculation of beta, share exchange 90 million share acquired using 8:9 share exchange ratio into 2.80. 224 000 write down. But there is a premium element also here. So that premium element we will add in other component of equity, working note 5. Premium on issue of share 80 into 1.8. How much is that? 1,44,000. So second effect is over, back to balance sheet. Then retained earning, working note 4. Only parent write down first. Parent retained earning is how much? 211,396. Right here, 211,396. And what about other equity? Other equity of parent 5604, working note 5. Okay. Now come to working note 1, net asset table beta. Now here we will write down share capital, retained earning and other equity of beta. So how much is share capital of beta? 1,20,000. Write in both the columns. And other component of equity, on the date of acquisition check, how much was that? 2,400. Now on the balance sheet date check, how much is that? 4,000, right? Which means 1,600 increase in net asset is due to other component. Now retained earning on the date of acquisition, write down 86,000. Now on the balance sheet date, 1,15,000. Okay. And then share capital of gamma I don't require right now. Retained earning, go to that investment in gamma equity, 9 working note. Share in post acquisition change in net asset. Retained earning. How much is the change in retained earning? Right now 76,000. On the date of acquisition it was how much? 66,000. And what is the stake in the associate? 40%. Add 40% increase in retained earning. How much? Is it 4,000? And try other component of equity in the same manner. Now it is 2,000. Previously it was how much? 1,200. Is it right? Say yes. Into 40%. 320. Just keep it here. Second effect also will give. Now this second effect will go in retained earning, working note 4. And this second effect will go in other component of equity, working note 5. So working note 4, add in the last third line gamma. Same calculation, 40%. How much is the answer? 4,000. Working note 5. Gamma, last line, gamma 300 and share in gamma post acquisition other equity 320. Yes. Any query up to other component of equity in the question? Non-current liabilities. Come to the main balance sheet again, non-current liability. Then provision we'll do later. Working note 7 will require a lot of discussion. Long-term borrowing, for the time being you tick mark two items. Tick mark 60,000 and 50,000. Deferred tax, tick mark two items. 22,000 and 25,000. Trade and other payable, tick mark 45,000, 40,000. Short-term borrowing 22,000, 20,000. No adjustment, total 40. Yes, 42,000, right in the outer column. So we have completed the SOFP given in the question. Some adjustments were pending. Now go adjustment wise. Okay. Any query till now? On 1st April 2012, Alpha acquired 90 million shares in Beta by means of a share exchange. The terms of the business combination were as follows. Alpha issued 8 share for 9 share. This we have done. Second line. Alpha will make further cash payment to former shareholders of Beta on 30th June 2015. This payment will be based on adjusted profit of Beta for 3-year period to 31st March 2015. On 1st April 2012, the fair value of this additional payment was estimated at 25 million. So you come to working note 2, write contingent consideration 25 million, 25,000, right? Wait for the second effect. This estimate had increased to 28 million by 31st March. So I have to pass one entry for 3 million. Retained earning account debit to contingent consideration. Come to working note 4. Second line, adjustment for fair value of contingent consideration. Write 3,000 here. So total contingent consideration for SOFP purpose will be how much now? 28,000. Come to liability side. There is a contingent consideration. Write 28,000. Over second effect. Next line. Neither component of the investment in Beta has been recorded. Now we will record. It is the group policy to value the NCI in subsidiaries at the date of acquisition at fair value. The market value of an equity share in Beta on 1st April 12 can be used for this purpose. On 1st April 12, the market value of a Beta share was 2.60. So you come to goodwill working note first. There we will write fair value of NCI on the date of acquisition 30 million into 2.60. Is it 78,000? And there is a working note on NCI also. Working note 3. Just below that, fair value at the date of acquisition, write 78,000. Next paragraph, question book in front of you. On 1st April 12, the individual financial statement of Beta showed the following reserve balances. This I have written 86 million, 2.4 million. The directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of Beta on 1st April 2012. The following matters emerged. Come to working note 1. Property adjustment from 140 million to 160 million. Is it 20 million? Write 20 million in both the columns. Property adjustment. The life is 16 years and only 1 year is over. But for calculating depreciation, I will take the difference between depreciable amount 92 minus 80 divide by 16 year. How much it comes to? 750. 750. Then plant and equipment adjustment. Somewhere below, plant and equipment adjustment. From 111 million, it has become 120 million. So how much is the gain? 9,000. Divide by 3 years. 3,000. Intangible asset. It was not recorded only. Now you record 8 million. 8 million, 8 million. Extra amortization divided by 4 years. 2,000. Now first we'll give the effect in the SOFP now. Okay. Then I'll come to deferred tax. Too many things at a time may confuse you. Now this 19250 is for property. 20,000 minus 750. This 6,000 is for plant and equipment. 9,000 minus 3,000. Tick mark. 9,000 minus 3,000. One item is still pending. I'll come back to that. Then intangible asset. How much will you write intangible asset? Intangible asset you write 8 minus 2. 6,000. Okay, now we'll come to this working note 1 again because it's almost done. How much fair value adjustment we'll have to do? Property, plant, intangible asset. So take total on your calculator 20 plus 9 plus 8. 37 into 20%. 7,400. In bracket write. Because it will give rise to DTL. Okay. Now again, dear student, take on your calculator 20,000 minus 750 plus 9,000 minus 3,000 plus 8,000 minus 2,000 equal to and into 20%. 6250. And now net asset for consolidation. Tell me the total of this entire thing. $238,000? No problem. And this one? Is it 2,64,000? It's written below. That is why I know. 2,64,000. Now first what you do, this closing DTL 6250, you transfer to balance sheet. Can you see 6250 is written here? 6250. Now tell me total deferred tax in the outer column. 53? 53,250. Okay. Any query on this now? Come back to working note 1. Now there is a note in this working note 1 below. The change in the post acquisition period is total 26,000. The difference between 264 and 238. Agreed? Out of this 26,000 on the screen, change due to other component of equity is 4,000 minus 2,400, that is 1,600. So which means remaining change is due to change in retained earning. Now this beta is a subsidiary. So we have to divide these figures in the ratio of the parent share and NCI share. How much is parent share? 75%. Very good. So come to retained earning working note. Retained earning working note, you will find written in the last fourth line, beta, 75% of 24,400. 18,000? Okay. Come to other component of equity, written in the last second line, beta, 75% of 1,600. 1,000? Come to NCI also. NCI working note 3. Now here we can write in 2 lines or 1 single line. 25% of post acquisition increase in net asset. 26,000 into 25%. How much? 6500. So total is how much here? Minority interest. NCI 84. 84,500. This 84,500. This item is closed. You can transfer to main page. NCI 84,500. And come to working note 1 again. What will you do with this total pre-acquisition net asset 2,38,000? This I will use for goodwill working. Goodwill working 2,38,000. So can you find out goodwill now? Is there any impairment of goodwill in this problem? No. So can I just go to balance sheet and write goodwill 89,000 now? Asset side goodwill 89,000. This completes my adjustment number 1 only. Okay. Adjustment number 2. Alpha's investment in Gamma. On 1st April 12, Alpha acquired 40 million shares in Gamma for a cash payment of 1.85 per share and debited 74 million to investment. That we have written in that working note. This enabled Alpha to exercise significant influence. Next line. In its own financial statement, Alpha treated investment in Gamma as FVT OCI. On 1st April 12, Alpha individual financial statement of Gamma showed the following reserve. This also we have done. You can see in working note number 4 we have added. Working note 5 also we have added. Our share post acquisition. On 1st April 12, there was no material difference between carrying value of net asset of Gamma in the individual financial statement and fair value. On 31st March 13, fair value of Alpha's investment in Gamma was estimated at 78.5 million, and this is the balance recorded in Alpha's individual financial statement. So what I will do, this 4.5 million which is credited to other component of equity, we will reverse on the screen. Working note 5. Understand the entry. Other component of equity account debit 4.5 to investment 4.5. Investment I have already reduced. So now write here 4,000 in bracket. We are reversing the OCI effect because we have to apply IAS 28. Then next paragraph, ignore deferred tax for this entry. Investment by beta and gamma. These investments are financial assets that are measured at FVT OCI and have been correctly treated by beta and gamma. The other investment of equity, other component of equity of beta and gamma relate entirely to this investment. Have we written the investment of beta in the balance sheet? No or yes? Investment, other investment, yes, done. Intercompany sale of inventories. Who has sold to whom? Alpha to beta and alpha to gamma. So come to working note number 4 first. In both cases it is downstream. Parent's profit will be reduced to the extent of, in case of beta, 1/4 of 14,000. How much is that 1/4 of 14,000? 3,500. And in case of gamma, which is an associate, 1/4 of 12,000 but multiplied by 40% also. How much is that? 1,200? 1,200. In case of this 3,500, the second effect will go to inventory. Where is inventory? Balance sheet. You see on the asset side inventory, 3,500 is written. Yes. Tell me the net amount of inventory in the outer column. 1 lakh? 37,500. And what about this effect? This will go in investment because inventory is lying with gamma. We don't have this inventory. So this effect you go to investment in gamma equity accounting, working note 9. Last line, write down in bracket 1,200. Okay. Point number 5. Trade receivable and trade payable. Come to balance sheet. How much is intercompany receivable and payable? 9 million and 7.5 million. So come to trade receivable. But one thing you should be sure that we are only going to eliminate subsidiary. For associate we don't make adjustment. Come to payable also. 9 million subsidiary. For associate we don't make adjustment. This is given to confuse you. So tell me what is total trade receivable in the outer column? 1 lakh? 3,000. And what is trade payable in the outer column? 76,000. Right here 76,000. Okay, adjustment number 6, share-based payment. There is a working note we have prepared for it. Working note number 6. This point we will read again for a better understanding. On 1st April 11, means previous year beginning, Alpha granted share option to senior executives that are due to vest on 31st March 14. Vesting period is 3 years. This year is the second year. Previous year was the first year. The maximum number of options that can vest is 10 million. However, there are vesting conditions that are service condition. Each option allows the holder to purchase a share in Alpha for $2.50 Further details are as follows. Now in this table, as far as fair value of share price is concerned, not important. The expense is not based on share value. Fair value of the option on grant date is important, 36 cents. So for the purpose of calculating how much expense to be recognized in this year, I will first compute the estimated total cost at the end of year 2, which is based on estimated number of option to vest on 31st March 2013. Can you see 9.3 million is written? My revised estimate is 9.3 million, and I will multiply it by the fair value on grant date. So can you tell me how much it comes to in thousand? 3348. This is my revised total estimation of expense. 3348, and then cumulative cost recognized up to be recognized up to 31st March 2013, 2/3 of this total. Is it 2232? Very good. How much cost that has been recognized up to previous year? This figure is given in the question. 1104. This they have given. So I am not doing anything for this. Even if you try to calculate, it will come to the same thing. But it is a kind institute. They have given you that number. What is my necessary adjustment? Entry. Expense account debit to share based payment reserve account. So you come to retained earning, because now this expense account is not there. So retained earning, third line, adjustment for share based payment, 1128 in bracket. One 1128, right here 1128 in bracket. Share based payment reserve, we will write in other component of equity. So last third line, adjustment for share based payment, 1128. Any query? This opening balance already contains last year share based payment, okay? And this is only current year, which they had not recorded. Now we will record. Next line, provisions. So there is a working note number 7 for that. This is a new adjustment for you. It says on 1st October 2011, Alpha entered into a 10-year lease of office premises at an annual rent of 20 million. This lease was correctly classified as operating lease and rental is appropriately charged to profit and loss. So this they have done correct. No adjustment required here. On 1st October 11, Alpha began carrying out alteration to the premises. These alterations were completed on 31st March 12 at a total cost of 18 million. Alpha included 18 million in the property, so that has also gone into property, and charged depreciation. On 18 million they have charged depreciation also. So up to this it is right. Okay. Then what is gone wrong? In terms of the lease, require Alpha to vacate the premise on 30th September 2021. Means there is a provision for decommissioning obligation. You have to clean everything, surrender the asset back to the owner at the same position and leave them in the same condition as they were on 1st October. The directors estimate this will require restoration expenditure of 14.25 million on 30th September 2021. Accordingly, the directors recognized a provision of 1.5 million. What they have done, They have just simply done the straight lining. We don't do straight lining. We calculate the present value and then we unwind the discount. At 31st March 2013, the directors debited 1.5 million to profit or loss when recognizing the provision. So you will find in the balance sheet 1.5 million provision is appearing in the balance sheet given to you. Is it there? But that is wrong. Okay. So now we will first understand the adjustment. How much provision they should have made on 31st March 2012, that is last year. They should have calculated the present value of future obligation. Future obligation is 14250 and this present value factor is given. Do not sit in the exam and start checking whether this factor is right or wrong. It is given, enjoy, it is 6840. This year we should have provided interest on this at 8%. How much it comes to? 547. Which means my closing provision should be how much? 73? This will go to SOFP. This is the right number. Then amount included in PPE, how much amount we should have debited to PPE? 6840, which we have not done. Last year we passed only one entry, that expense to provision, and that means if I would have correctly recorded this figure, I would have provided depreciation also on this year. Divide by 9.50, 6840 divided by 9.5, 720. So my fixed asset figure would increase by net amount of increase in fixed asset 6840 minus 720. Haji, 6120. 6120. Amount chargeable to P&L account. This year I should charge 547 and 720 to P&L account. So that comes to how much? 1267? Yes or no? If I would have done correct accounting, this is what I would have charged. But amount already charged in the financial statement is 1500. So now what I'll do, I will have to make an adjustment equal to 233. Are we going to add or subtract? Add. I have already made this much provision for expense, but I should have provided only 1267. More expenditure has been charged. So I will add 233 in the retained earning. In retained earning. Go to retained earning, add 233. You will find it is written there. Adjustment for provision working note 7, 233 write down here. And then go to balance sheet. In balance sheet, my fixed asset will increase by net amount 6120. Now you add 6120 and tell me the figure. After adding 6120, what is PPE figure now? $536 536370. Okay, wait a minute. Go to liability side. How much provision that should come in your balance sheet? 73? Sure. 7387 provision should come in the balance sheet. Any problem on this adjustment? No. So this was an important adjustment which you have successfully executed. Okay. Now, long-term borrowing that we had discussed. It is easy. So this is long-term borrowing of Alpha includes 20 million that was received from a consortium of bank. The loan does not carry interest, but 30.6 million is repayable on 31st March. Alpha's incremental cost is $1 million. So you have learnt in IFRS 9 and IAS 32, any transaction cost will be adjusted, okay, unless it is an FVTPL instrument. This is not an FVTPL instrument, this is amortized cost instrument. So the loan will be initially recognized at 39,000. And then you will pass entry for interest accrual every year on the opening balance. Interest account debit to loan account 39. No, this is 19. Interest account debit to loan account 1900. So my total loan will be now 20,900. And how much finance cost I have charged in the draft financial statement? Only 1,000 we have charged. So how much I need to charge more in the profit and loss account? So my entry for rectification will be retained earning account debit 900 to loan account 900, because loan is appearing in the balance sheet at 20,000. So retained earning reduce 900, here adjustment for carrying value of loan, plus or minus. And second effect in the loan in the balance sheet, it's already 20,000 there. Where is that loan? 20,000 was already included here. I need to only increase it by 900. So now what is my total amount of the loan? 110,900, correct? Okay, now we have done this problem. So let us see which working note is pending. This I have done. Goodwill done. Retained earning is pending. Total is pending. Haji. 224,201. Okay. And this one? 147? 750? Okay. And this NCI I think we have done. Share based payment over, provision over, loan over, investment over. This deferred tax working is homework. Okay. Come to main balance sheet. And in main balance sheet, two figures are pending. One is this retained earning. How much you said? 2 lakh? 24,000? Exactly? Huh. And other component of equity? Okay. Seems that we have done all adjustment. Now total of the assets here. 10,13,990. Take liability side total also. Same. Wow. 10,13,990. This answer is over. This chapter is over.